What if the biggest move in the silver market this decade didn't happen during trading hours, but quietly, in the dead of night, while most of the world was distracted by Christmas lights, closed banks, and empty trading desks? While most people were focused on last-minute holiday plans, wrapping gifts, or preparing for Christmas Eve dinners, something far more consequential was unfolding behind the scenes of global finance. In a narrow window of just a few hours, three powerful regulatory institutions launched a coordinated intervention into one of humanity's oldest and most tightly controlled markets. The timing was deliberate. The mechanics were precise. And the objective was unmistakable: halt a silver price surge that was edging dangerously close to exposing structural weaknesses the system can no longer hide. This was not random volatility. It was not organic price discovery. It was a calculated response to a market that was slipping beyond regulatory comfort. And despite the speed and force of the intervention, early evidence suggests the strategy may already be unraveling. In the early hours leading into Christmas Eve, silver became the target of a rare, synchronized regulatory maneuver. Between late Tuesday night and the early morning hours, a sequence of emergency announcements hit the market in rapid succession. Each move alone would have been notable. Together, they formed a coordinated pressure campaign designed to force liquidation, crush momentum, and reassert control over pricing mechanisms increasingly disconnected from physical reality. To understand what happened and why it matters, you have to examine the sequence minute by minute, dollar by dollar, and layer by layer. Because this was not just about silver prices. It was about power, control, and the growing conflict between paper markets and physical supply. The first move came just before midnight Eastern Time. Late Tuesday night, the CME Group issued an emergency bulletin announcing a dramatic increase in margin requirements for silver futures. Effective immediately, traders holding silver contracts would be required to post substantially more capital to maintain their positions. There was no phase-in period, no grace window, no adjustment buffer. By the first minutes of Christmas Eve, the rules had already changed. For those unfamiliar with futures markets, margin requirements are the collateral traders must hold to keep positions open. Under the prior structure, one silver futures contract required roughly $15,000 in margin. Overnight, that requirement jumped to more than $26,000 per contract. For anyone holding size, the increase was staggering. What made the move especially potent was not just the magnitude of the increase, but the timing. The announcement landed late at night, just hours before a holiday when banks operate on reduced schedules or are closed entirely. Even well-capitalized traders suddenly faced a logistical nightmare. Funds that existed on paper became inaccessible in practice. Wiring tens of millions of dollars on Christmas Eve morning was effectively impossible. Automatic liquidation became the default outcome for anyone unable to meet the new requirements immediately. 90 minutes later, a second blow landed. The Commodity Futures Trading Commission released its own emergency action, imposing new position limits on silver contracts. Large market participants were suddenly restricted in how much exposure they could legally maintain. Positions exceeding the new caps would have to be reduced quickly or liquidated by the exchange itself. This move directly targeted institutional players, hedge funds, commodity trading advisors, and large capital pools that had accumulated meaningful long exposure during the rally. While retail traders were largely unaffected by the numerical limits, the institutions driving liquidity were forced into compliance under tight deadlines. Then, just before dawn, the final message arrived. The primary U.S. Silver Futures Exchange issued a statement warning that trading halts and even liquidation-only sessions were on the table if volatility persisted. In plain language, the exchange was signaling its willingness to shut down buying altogether if prices continued rising. This trifecta of actions, margin hikes, position limits, and the threat of buy-side shutdowns, was unprecedented in its coordination and timing. These announcements do not typically occur in the middle of the night before a major holiday. When they do, it signals stress at the system level. Before going further, it's important to state clearly that nothing here constitutes financial advice. This is analysis and interpretation of public market events. Precious metals markets are volatile. Futures trading involves significant risk, and individual decisions should always be made with professional guidance. What follows is an examination of mechanics, not a recommendation. Now let's examine why this intervention was structured the way it was and why it may fail. Imagine a large commodities fund that entered the week positioned for a silver breakout. Early in the week, silver was trading in the high 60s. Based on supply deficits, rising industrial demand, and tightening inventories, the fund accumulated several thousand long futures contracts. Under the old margin rules, the position was comfortably funded with sufficient excess capital on hand. As silver surged into the mid-70s over the next 2 days, the fund's position ballooned in value. On paper, profits were substantial. Risk appeared manageable. Confidence was high. Then came the midnight email. Suddenly, the capital required to maintain the same position exploded upward. What required $45 million one day now required nearly $80 million the next. The fund did not suddenly become reckless. The market did not suddenly invalidate the thesis. The only thing that changed was the rulebook. The deadline to comply was brutal. Funds had to be deposited within hours during a holiday under threat of automatic liquidation. Brokers could not extend credit without jeopardizing their own compliance. Appeals were useless. Systems would enforce liquidation mechanically. At that moment, every option available was bad. Selling contracts into a thin holiday market meant accepting steep losses as prices cascaded lower. Doing nothing meant forced liquidation at whatever prices the system could obtain. Raising capital was practically impossible. This is the essence of a forced liquidation event. It has nothing to do with fundamentals. It is purely a function of timing, leverage, and regulatory authority. The intended outcome of such events is well known. Forced selling drives prices down rapidly. Stop-loss orders trigger additional selling. Liquidity evaporates. Prices overshoot to the downside. And participants positioned short the market, often large banks, are able to close positions at much more favorable levels. History shows this playbook can work. In 2011, silver surged to nearly $50 before repeated margin hikes crushed the rally. Over a short span, leverage was stripped from the system and prices collapsed into the low 30s. The intervention succeeded because the rally was driven primarily by speculative leverage. But this is not 2011. The current silver market rests on a fundamentally different foundation, and that difference is critical. First, the physical supply deficit is real and growing. Global silver demand now exceeds annual mine supply by over 1 billion ounces. That gap is being filled by above-ground inventories that are rapidly shrinking. Warehouse stocks backing futures contracts are thin relative to outstanding paper claims. The ratio of paper promises to physical metal has reached extreme levels. No regulatory announcement creates silver. No margin hike opens a mine. No position limit refines metal faster. The shortage exists regardless of paper rules. Second, industrial demand has transformed the market. Silver is no longer primarily a speculative or monetary metal. It is a strategic industrial input. Solar panels, electric vehicles, advanced electronics, medical devices, and energy infrastructure all require silver. This demand is non-optional. Production lines do not stop because futures margins rise. Large manufacturers operate on procurement schedules, not price charts. Their mandate is continuity of supply, not price optimization. If paying a premium avoids shutting down production, they will pay it. Temporary dips caused by paper liquidation often become buying opportunities for these players, not deterrents. Third, options market dynamics introduce mechanical buying pressure that cannot be overridden by announcements. As call options move into the money, market makers are forced to hedge by buying futures. This hedging is governed by algorithms, not discretion. The math executes regardless of holidays, sentiment, or regulatory discomfort. Together, these forces create a market structure that is far more resilient to margin-based suppression than past cycles. When trading resumed after the overnight announcements, the expected collapse did not fully materialize. Prices did dip sharply in thin electronic trading. Forced selling was visible. But instead of cascading lower, the market found aggressive buyers. The bounce was swift. Volatility increased, but control did not return. That price action reveals something important. Real demand absorbed the forced supply. Participants with capital and conviction stepped in. This is not what a broken rally looks like. The true test, however, does not occur in New York during a holiday week. It occurs when global physical markets respond. Asian trading sessions provide critical signals. If paper prices fall while physical premiums remain elevated or rise, the disconnect becomes undeniable. A widening gap between futures prices and physical delivery pricing is the market's way of exposing stress. It signals that paper liquidation is not solving the underlying shortage. It is merely distorting the visible price temporarily. If that gap persists, confidence in paper pricing erodes. Delivery risk increases. Participants accelerate efforts to secure physical supply. The feedback loop intensifies. Looking ahead, the sequence matters. Volatility dominates the immediate aftermath. Regulatory bodies assess whether the intervention slowed momentum. Traders reassess risk. But the decisive moment comes when markets reopen fully and liquidity returns. If prices stabilize or recover quickly, the message is clear: the intervention failed to change behavior. At that point, options hedging accelerates again. Breakout levels trigger additional demand. Inventory stress worsens. From there, repricing becomes nonlinear. Prices gap rather than grind. Reference points disappear. Models break down. For participants holding physical silver, none of these paper maneuvers change ownership. Metal in hand is unaffected by margin rules. It does not receive liquidation notices. It does not require collateral. In periods of stress, physical ownership carries asymmetric advantage. For futures traders, the calculus is different. Capital requirements matter. Risk tolerance matters. Volatility cuts both ways. Each participant must assess their own constraints. For those holding paper proxies, delivery risk becomes the central concern. Cash settlement clauses matter when physical supply is tight. Understanding the structure of what you own becomes critical. Zooming out, this episode is about more than silver. It illustrates a broader tension playing out across commodity markets. Financial engineering has expanded claims far beyond underlying assets. Regulation has been used to manage symptoms rather than causes. When physical constraints assert themselves, the system responds with rule changes. But rules cannot create molecules. Somewhere right now, long-term holders of physical metal are unmoved by these events. They are not leveraged. They are not reactive. Their metal is unavailable to the market regardless of price. At the same time, industrial buyers are securing supply aggressively, often indifferent to short-term fluctuations. Their concern is continuity, not speculation. Between these two forces sit institutions that sold promises they may not be able to keep. The midnight intervention was an attempt to buy time. It may succeed briefly, but time is the one resource physical deficits consume relentlessly. As inventories drain, as demand persists, as leverage is wrung out, the paper market's ability to suppress price weakens. Either physical prices decouple entirely, or paper prices are forced to adjust upward. That is the crossroads we are approaching. What we are witnessing is the early stage of a structural repricing, not a trade, not a chart pattern, a transfer driven by physics, not policy. This story is far from over. In many ways, it has just begun.